In today's ever-changing financial world, here's a bold fact. Predicting the stock market is risky business. But here's a question. How can you protect your money? Stick around as we share straightforward tips to help you navigate the ups and downs of investing. Elevate your finances with WealthWise Insider. Wisdom for wealth builders. Hey everyone! In today's video, we're tackling a hot topic in the financial world, the possibility of a stock market crash and how to navigate through these uncertain waters. There's a lot of noise out there, especially on YouTube, where financial pundits are painting doomsday scenarios and setting dates for the next big market downturn. Let's get one thing straight right off the bat. Trying to predict the exact timing of a market crash is, for the most part, a fool's errand. If someone happens to call it correctly, chances are it was more luck than skill. Now onto market valuations. They are a critical piece of the puzzle when trying to understand where we stand with the stock market. One key metric that gets a lot of attention is the stock market to GDP ratio, a favorite of investment giants like Warren Buffett. This ratio has historically been a reliable indicator of whether the market is over or undervalued. And guess what? Right now, it's signaling that we are in one of those overvalued phases. But here's where it gets interesting. Just because the market is showing signs of overvaluation doesn't mean you should hit the panic button and sell everything. History has shown us that markets can remain in this overvalued state for quite some time before any correction occurs. Indeed, since 2017, we've been in such a phase, and yet the market has continued its upward trajectory. Another indicator that's worth discussing is the cyclically adjusted price to earnings or CAPE ratio. Like the market to GDP ratio, the CAPE ratio is currently indicating that stocks are pricier than they have been historically. Both these indicators are flashing warning signs of overvaluation. However, it's crucial to remember that these indicators, while informative, are not crystal balls. They don't predict market movements with certainty. The stock market is a complex beast that can act irrationally longer than any of us can remain solvent. That's why making investment decisions based on speculation or fear of a crash is generally not advisable. So what's the best approach in times like these? First and foremost, avoid the temptation to engage in panic selling. For most people, the goal of investing is to build wealth over the long term, often through regular contributions to retirement accounts. If you're fortunate enough to have a substantial nest egg and want to be more cautious with new investments, that's a reasonable stance. But for the vast majority, sticking to a regular investment strategy, particularly through diversified ETFs, is likely the wisest path forward. Consider this startling statistic. If you had missed the top 10 trading days in the last 30 years, your returns could have been cut in half. This fact alone illustrates why attempting to time the market is often a losing strategy. The focus should instead be on consistent investment over time, not on jumping in and out based on market predictions. When considering investment strategies, it's crucial to acknowledge the impact of fees on returns. Studies have shown that high fees can significantly eat into investment gains over time. For example, a 1% difference in fees may seem insignificant, but over decades it can substantially reduce overall returns. Additionally, passive investing through low-cost ETFs has gained popularity due to its simplicity and cost-effectiveness. ETFs offer diversified exposure to various asset classes, mitigating risk and potentially enhancing long-term returns. By minimizing fees and embracing diversified investments, investors can optimize their portfolios for sustained growth. If and when a crash does occur, it might actually present an opportunity to buy quality investments at a discount. The adage is not about timing the market, but time in the market rings especially true. Markets will have their ups and downs, but over the long term, they tend to increase in value. But let's delve a bit deeper into why consistent, long-term investment is so crucial. The stock market, by its very nature, is volatile. It reacts to a myriad of factors, including economic indicators, political events, and even investor sentiment. This volatility can be intimidating, especially for those new to investing. However, it's also an inherent part of what offers the opportunity for growth over time. The real value in investing comes from compounding returns, earning returns on your returns over many years. This process requires patience, discipline, and a long-term perspective. By committing to regular investments over time, you effectively average out the cost of your investments, mitigating the risk of investing a large sum at an inopportune time. Moreover, diversification is key. By spreading your investments across different asset classes, sectors, and geographies, you can reduce risk and increase the potential for steady returns. This is where low-cost ETFs come into play, offering a simple and effective way to achieve diversification. It's also worth noting that every investor's situation is unique. Factors such as age, financial goals, risk tolerance, and time horizon should all play a role in shaping your investment strategy. For those closer to retirement, a more conservative approach may be appropriate, while younger investors might opt for a more aggressive strategy given their longer time frame to recover from potential downturns. Engaging with the community and continuing your financial education can also be incredibly beneficial. Whether through online forums, investment clubs, or financial advisors, being part of a community can provide support, share knowledge, and offer different perspectives. Understanding the historical performance of the stock market reinforces the significance of maintaining a long-term perspective. Over the past century, despite numerous downturns and crises, the stock market has consistently demonstrated resilience and upward trajectory. For instance, analysis of the S&P 500's historical returns reveals that, on average, the market has yielded positive returns over rolling 10-year periods. This long-term view underscores the importance of patience and discipline in weathering short-term market fluctuations. By focusing on the enduring trend of market growth and compounding returns, investors can better navigate volatility and achieve their financial goals. To sum up, despite the overvaluation signals and the speculation about the impending market crash, the principles of successful investing remain unchanged. Stick to your long-term investment plan, continue making regular contributions, and maintain a diversified portfolio. Remember, steady investment, diversification, and a long-term mindset are your allies in the unpredictable world of finance. Now, what steps will you take to secure your financial future? Share your thoughts in the comments below. And don't forget to subscribe to WealthWise Insider for more insights on achieving financial prosperity. Until next time, remember, smart wealth, wise future.